Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and it is another edition of Investment Friday with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. Brad, you're here.
I'm here. How are you?
I'm good. I have had just some amazing client meetings today. It fills my heart. So anyone who's listening, if I had a meeting with you on Thursday, September 19th, it was amazing. And I always love talking to you. And if I didn't have a meeting with you and you're one of my clients and you're listening, I also love you and love meeting with you. So just so we got all our bases covered.
Yes.
But it truly is such an honor and a pleasure and my favorite thing to be able to sit with my clients, talk with them, just be there for them in the way that I can. So I've had a great day. How about you?
That's awesome. I've had a great day too. Um, it's interesting as when I first got into managing money and working with financial advisors like yourself, 30 years ago, it was more you had to do business a certain way, right? And it's interesting because now current times, financial advisors can really customize who they do business with, how they do business with those clients, and it really does up the job satisfaction for financial advisors, and then that translates to happier clients because you're both engaged and you're both on the same side of the table working and pulling the oars towards the same goal. So yeah, I'm glad you're enjoying it today. My day was actually pretty fantastic. And you can see if you look at the markets, this is Thursday, September 19th. So the markets were up a lot today, which is fantastic. So I want you to sit in that moment as a client or as an investor and understand that it's a good thing to have your assets appreciating. Now, is it for real? I don't know. We have something happening tomorrow, which is what we call triple witching, which is expiration for options contracts and futures on options contracts. And so we have a really large amount of money, about $5.1 trillion. That's the highest ever that's coming due tomorrow. And so that tends to increase the volatility both up and down during the couple days before and the day of that expiration. So I hope it's for real. I think it's going to be for real, but until next week, we just really don't know.
So what I'm hearing is that on a fundamentals level, hopefully this is real, the lift we're seeing. And so why is that? So we're gonna dial it back just a minute here and get back to that triple witching, because I think people are gonna be like, what does that mean? Tell me what that means. Yesterday on Wednesday, September 18th, Jerome Powell came out after the Fed meeting and said that they were cutting interest rates by 50 basis points, or half of a percent, 1/2 of 1%. So what did we talk about last week? We talked about this exact scenario, right? Like, what's going to happen if he comes out and says they're cutting by a quarter of a percent or 0.5%? Which ways can it go? Yesterday, the market took a turn. It tanked at the end of the day, deciding that 0.5%, kind of worried. Like, oh, does that mean that they're worried about the economy because they made a bigger cut? Like, that was kind of the messaging that was kind of spread through. So tell us more about that.
Yeah. So last week we talked about it. I said it's very important, the commentary that is associated at the press conference associated with the interest rate cut. It's really important that Jerome Powell is very clear in the communication and really not trying to scare anyone's side. If growth is weaker than, so you don't have this battle between, is growth too weak or is inflation heating up? It's the battle between the two. And so yesterday, I think he did a pretty good job. It was pretty wild intraday trading yesterday, as you said, with they came out, it spiked up very, very quickly and then sold off towards the end of the day. Today, we're rallying pretty significantly. But a lot of that, I believe, I think has to go to, during the press conference, they outlined kind of the median of the future interest rate cuts. So for example, he said, we're doing 0.5% right now. We also have 2 more cuts this year, most likely. Okay, so it'll be a full percent in 2024. They will have cut interest rates. In 2025, we have 4 more interest rates cuts that are expected as inflation continues to decelerate. And then in 2026, 2 more interest rate cuts. So you're at about 2.5% from peak to where they're saying, hey, that's when we're going to end. So basically, you're looking at a 3% target Fed funds rate or short-term interest rate, by mid 2026. So that's a really important number because that matches where nominal GDP is on an annualized basis around right now. So it's something that's important to understand, that they want to get it down to more neutral territory, and it takes a while to do that. But I think the 0.5%, I thought they should have done 0.25% in July, but here we are. So they caught up and they did 0.5% in September. That will be very impactful for a lot of households. Right now, it's been very advertised. A lot of households have a tremendous amount of credit card debt, and credit card debt on the average is 22% on the average credit card. Well, short-term interest rates should affect that pretty quickly. Those rates should be coming down particularly over the next 18 months, but probably over the next couple of weeks in a little more quick fashion. Similarly, over the next month or 3 months, short bank loans, which again, a lot of small businesses rely on bank loans, and those are floating rate instruments. A lot of the small businesses will start getting a pay bump because now their interest expense is going down, which is great because it's going to be supportive of profits for those smaller companies.
That, and it trickles into mortgages pretty quickly as well, right? Or people who have, I have clients who have home equity lines that are floating rate, right? Or variable rate. You might hear when you have a home equity line of credit. And so those interest rates are typically tagged to the prime rate plus 2% or whatever your rate is. So those should come down as well, right? By a good
Measure. Yeah.
bit.
Yep. Fixed mortgages will take a little bit longer because as was very, very advertised, a lot of people have very low cost mortgages, fixed rate mortgages that they're keeping a hold of. It's one of the reasons that the housing market kind of locked up a little bit, because everybody's like, well, I've got a 3.5% mortgage or a 3% mortgage. Why would I go get a 7% mortgage
Right.
on a house that's more expensive? So I think interest rates have to come down a little bit further for those mortgage rates on the fixed rate mortgages to come down to where you start to see people looking at and going, okay, if it's 4.5%, maybe we can step up into another house or what have you. So those are going to have to come down a little bit more. But like you said, home equity lines, credit card, auto loans, if you're looking to buy an auto, all of those are very, very quickly impacted by low rates.
So super interesting. I know like some people might be in the same boat as me. We're looking to move next year, next summer when the kids get out of school before they go up into their next school year. So, gosh, if we're down a percent, right, full, well, maybe even percent and a half from Fed fund rates by that time, yeah, like that feels like a much easier time because I think our mortgage here that probably secured a refinance in like 2020 or so was around 4%.
Yeah.
So, it's not, we didn't have that 2% that some people, or, 3% that some people got. We didn't get quite that lucky. But it was, looking at homes and looking at okay, what's this payment at 7%? What's this payment at 6.5%? You kind of swallow a little hard. You're like, oh, yikes, okay.
Yeah. The lower the rates, the easier it's going to be to afford those more valuable houses.
Hmm.
And so, that should unlock some more demand. But again, as we talked about last week, I think the housing market is more of a supply issue than a demand issue at this point. So,
Yeah. But the mortgages, even like regardless, just like purely the interest rate on the mortgage does make a big difference. Um, there's a whole, we could talk to realtors about that, right? They have lots of opinions um, on that, but without going there, so let's move back over to no, no, no. I don't want to move back over to that yet. Can you share the chart that you showed um, our advisor team yesterday? Because I think it's just really good to always pay attention to what's happening right now, what's causing markets to fluctuate, right? It's good to know, it feels good to have an idea of what's happening, but it's then always super important, and I do this with my clients all the time, to zoom out and to say, okay, what does this usually lead to over a longer span of time? If we get really myopic and really like focused in on the what's happening today, what's happening this week, what's happening this month, the volatility can sometimes feel really anxiety producing. And when we zoom out, we get to have a much smoother picture of okay, day to day volatility happens, but here's what it looks like when we zoom out to 6 months, 1 year, 2 years plus. So
exactly.
back to,
So
oh,
if you
hold
could,
on. I'm going to let you
yeah.
share. So if you're watching on YouTube, you'll be able to see this, and then we'll walk you through the chart that we're looking at.
Okay. So what this is it was an analysis put together by another group. Actually, it's Pinpoint Macro Analytics who put it together. It's a colorful chart that goes over the historics since 1973 of what happens to the S&P 500 subsequent to the first interest rate cut of a cycle. And it gives you three different periods of subsequent returns. The first one is 3 months after the first rate cut. The second column or the second period is 6 months after the first interest rate cut. And the third column is 1 year after that first interest rate cut. And it gives you the historical returns on the S&P 500. And then it aggregates them and gives you an average. And what I told people yesterday on our advisor call is I said, look, if you just want to, don't worry about the numbers, just scan back and just look at the colors. So the first column, which is the shortest amount of time after the first cut, which is 3 months, it's about 50-50 between red, which is losses, and green, which is profits. It's about 50-50. In the second column, the 6th month, a little more green, a little less red. Okay, so more profitable periods than loss periods. And finally, when you get to the final column, which is 1 year out, you can definitely see that most of them are green. You have a few exceptions to that rule, but for the most part, it's green, and it's pretty decently green for equity investors. So what I like to tell people is, we've got a lot of anxiety producing events coming up. We have the election coming up in the beginning of November. We have tomorrow for us triple witching. Again, may cause some volatility. we have inflation, we have geopolitical concerns with Israel and Hezbollah and Hamas and the Ukraine-Russian war. You have China and Taiwan. You have lots of different flare points that could really cause a lot of anxiety for investors. But I also want them to sit back and go, okay, how much of this money do I need in the next year? How much of my investment portfolio do I need in the next 12 months? For many clients, it's not a very high percentage of their investment portfolio, right? Generally, investment portfolios are longer term. They're trying to help you get to your financial goals, whatever they may be at this stage in life, whether you're accumulating assets or you're living on those assets as a retiree or what have you. So what I tell people is, look, just make sure you have enough cash. If you're living on those assets, have enough cash that if we have volatility for the next 12 months, you're fine. And if you're accumulating assets over the next 12 months, that's great if we have volatility because it gives you opportunities to buy these assets cheaper.
Right.
So that's fantastic for you if you're an accumulator. If you're living on it, it can be a little bit more disconcerting when we go up and down in value.
So thank you for sharing that. I always love when we have something that we can share from, like, when we share these charts. This is literally the stuff that Brad helps us look at and review as advisors. Um, just to say, like, hey, here's what's going on in the economy. Here's what clients might be seeing and feeling and thinking about. So part of the reason we even do these Investment Friday episodes is because it's like, it's really cool to be able to share that with more people, like not just our clients, but like with a broader audience. Um, so it's very cool that we get to share all of that since you work on it every single week to share with us.
Yeah, I do. And I try to make them as valuable and educational as possible. Sometimes it's not always a win, but sometimes it does bring up some pretty good illustrations that are interesting for people to know.
Yeah. So with that, let's talk about um, what the triple witching means. And so what's happening tomorrow, who might be affected by this event, and something similar happens a couple of times per year, right?
Yep.
Where a lot of options contracts expire on the same date. So tell us a little bit more about what all that means.
Okay. So triple witching, hold on. I just got to get my screen.
Gonna show some more charts here, I think.
Oh, yeah. I will try to.
Well, first we can talk about what are option contracts. Some
Yeah.
people might know what stock options are, right? Like, I think more people are familiar with stock options because it's something that they know exists, at some employers, bigger employers that give out stock options to their employees. It's not exactly the same, but the concept is similar when we talk about option contracts.
Right. So options contracts are essentially an instrument where um, there's a couple of ways to explain it. The way I'm going to explain it is like the way a trader tries to understand it. So I apologize. So work with me here.
I'll translate if I need to. That's what I'm here
Thank
for.
you. Options contracts are ways to express investment views using leverage. Okay.
It's the way I would say that in plain English is you get to bet if a stock is going to go up or down.
Yep. With a smaller dollar amount. Okay.
Right.
So instead of investing $10,000 by buying XYZ stock, I can buy $1,000 call option on the XYZ stock. And for simplistic purposes, it goes up the same. Okay. So instead of, if it goes up 10%, so it goes from 10,000 to 11,000, well, on that stock, that's 10%, but on that option, you know, uh, being simplistic, it's a double. You've earned 100% on your investment. So there's a magnification of that benefit. So it's a very efficient market. It's very simple for traders or professional investors or individual investors, for that matter, to express investment views with smaller dollar amounts, but the potential for very, very high gains. Also potential for very, very large losses. So
Right.
let's make sure we're looking at both sides of that equation. So what happens is 4 times a year, every quarter, there comes a Friday where all of the stock options, the futures contracts, and index options, stock options, and options on stock index futures expire. Okay, they mature, they expire, they disappear basically. So when that happens, traders then want to, because that affects their positioning, they need to reposition their portfolio, their trading portfolio, to make sure they're ready for the next week. So sometimes it can get really volatile depending on who's trading what and how they're trying to position, whether they think it's going to be bullish or whether they think it's going to be bearish in the aggregate. So it can impact trading on a short-term basis on the Thursday and Friday before expiration. And that's what we have happening tomorrow. And it's a very large dollar amount. So that's why it impacts every asset, every stock on practically on the market that a client owns. It's going to impact it at least a little bit, particularly those that are in the large cap indices, the small cap indices. If a stock isn't in one of the highly traded indices, probably won't impact it that much. But the bigger, the more liquid you are as a stock, the more you're in these indices, the more impact you're going to have.
So the other thing I wanted to say about options contracts is that we use them at
Mhm.
Juncture in different ways. And so when people hear, some of these sounds complicated, and they are. It's not to say that they are um simple instruments by any means. They're not. They are complicated. Um and they can be very, very effective at protecting against loss, and also gaining more income on positions that you own, right? So we use some different strategies to do both things, to both enhance income or to protect against losses. And so those are different options contracts that we can use in portfolios just to make sure that, we're meeting the needs that our clients have, for either not losing money, and we can buy put options. We're not going to explain what all of these are, but so if your stock starts to lose money and it triggers that option, you can, right? You can set, you can
Yeah.
buy. I've
Yeah.
got that right.
Yeah. So options aren't good or bad. Options are just tools. They're
Mhm.
just tools to do different things. Um, a lot of them get um, kind of a bad press a lot of times because you'll hear about someone taking a very large position in a call option and it goes bust, so they lose a lot of money,
Mhm.
or that it hits, they make a ton of money. Well, that's only one small part of what options can actually do for an overall portfolio. They're not for the faint of heart, and they're not for someone who doesn't know, who's not educated as to what and how to deal with options. Like you said, we use options on a strategy to help augment the cash flow of that portfolio. And it's done very, very well. It's a very pretty stable portfolio that has a high cash flow. And we use them for times during heavy market distress to offset some of that downside volatility. And then in certain instances with some aggressive clients, when we're at the bottom or close to the bottom, we then sell that hedged option, that put option, and we go long. So which means we increase our exposure to the equity market. We buy stocks that are cheap at that point, and then we ride that wave, hopefully back up to the top, but it depends on how long it takes. So
Right. And
so
I
they're just a tool.
right. I wanted to share that because some people might know of options again because they have stock options from their employer and they know a little bit of how that works, which again is different. We can talk about that some other time. Um, or they've heard, from Reddit and some, like the craze around GameStop or what were some of the other meme stocks, AMC, so some of the other ones that got kind of hit with that, like
Well, and zero day options are
right.
were, I don't know if they still are, but they were a massive craze about a year ago. And that is basically, it's a gamble. You're basically buying it one day before expiration to see if you can make a little money because it's trading at 2 cents. And if it goes to 3 cents, you've made 50% of your money. It's just kind of crazy stuff. But that's speculation. So I want to
Right.
separate what we do from those speculations. We do not speculate with options. More often than not, we use it to enhance income or protect the principal of the portfolio.
Right. Yeah. That's what I wanted to get at too. Just to say, there's lots of different ways to use it. And if you use them appropriately, wisely, prudently, I think is probably the best. We are as fiduciaries um required to be prudent investors on behalf of our clients. So using things prudently is different from using things speculatively.
For
To
sure.
have that crazy gain, right?
For sure.
Or crazy loss. And also, just as a reminder, in case anyone ever hears about, well, so and so made a huge, made so much money on this one position. Like, remember, people like to talk about that. They like to talk about their wins. They don't necessarily like to talk about how they lost 75% of it the next day. Um, right, which happens just as
Happens a
often,
lot.
right? Or lost all of it and then some. So anyway, let's move over to talk a little bit about the different not tax plans, but economic plans between um, our different candidates, right? So former President Trump and Vice President Kamala Harris. We've got some plans now. They've both put out their platforms. What do they want to do? What's the economic plan that they want to put forward if they're elected president? And they have been analyzed by the Wharton School, right? And so Wharton's come back after putting through, some of these, putting the plans through their paces, analyzing what it'll do to the budget deficit, what it'll do to spending, government spending, and what we might see in the next 10 years. So Brad, what are they forecasting?
Yeah, so the University of Pennsylvania's Wharton School of Business has a budget model, and if you want to go, you can go on the internet, and it's www.budgetmodel.wharton.upenn.edu.
That's a
So
lot.
if you,
We'll put that in the show notes.
yeah, we can put that in the show notes, but it is they've analyzed the different proposals, and they've come up with its impact over the next 10 years. Economic models are not short term by any stretch of the imagination, and they do not they say that only they say only that these are what the impacts they can measure. So there are other impacts that, for example, if the Congress doesn't pass it or the like, they're assuming everything gets passed and enacted. So let's start with Vice President Kamala Harris. She's put out her proposal. And the budget model from Wharton talks about they project her spending increase over the next 10 years by 2.3 trillion. Okay, over the next 10 years. So that's the amount of spending she will do in excess of what today is currently law. She's also going to increase conventional tax revenue, right? We've heard that she will allow the Trump tax decreases to expire in 2025, and that will start to increase tax revenue on a short-term basis. And that those tax increases incorporate about 1.1 trillion over the next 10 years. So her net deficit in extra spending is at about 1.2 trillion. Now, if you account for some of the negative economic feedback cycle, it takes that 1.2 to about 2 trillion in excess spending over today. Okay, so that's
Like
kind of the net impact.
new deficit.
New deficit,
Yeah.
right? Really new debt by the time 10 years is over. Who does better? Well, in her plans, if you're a lower to middle class income household, you will do better under her plan. If you are a high income earner, you will do less better or less well under her plan. Primarily because that's where a lot of the tax increases come, is for the higher income earners. For example, she wants to increase the net investment income tax from 3.8% to 5% on households making over $1 million a year. Okay. So that obviously impacts those families. And so because of her proposal, she wants to increase capital gains, long-term capital gains. She wants to increase the net income investment income tax. She wants to increase the marginal rate, the highest marginal rate. All of those said together, if you're in the highest income levels, you're going to do well because you're in a higher income bracket, but you're just going to do less well relative to today's outstanding tax law.
And
now,
what does that, before you move on, what is that, the threshold for the highest marginal tax bracket?
That's a good question. I think it's over $1 million, but I want to make sure. Yeah, I believe it is, because $1 million, that's where she also has the new top rate for long-term capital gains tax of 28%. So they're going to increase capital gains taxes, the income tax bracket, and then also the net investment income tax. So all of those will hit the highest over $1 million households. Whereas people that are making, in the lower economics, lower income levels will probably do far better, because she's going to cut taxes and or give spending programs to help you more. Okay.
Right.
So that is relative to hers. Now, former President Donald Trump. Okay. We've heard a couple of his proposals, no tax on tips, which, to be honest, has always been a very difficult one to enforce. The IRS pulls their hair out when they see a waiter or a waitress or a hostess or a bartender, because they know they're getting a lot of cash tips. They don't know how much of those cash tips are actually being reported or not. So it's been probably compliance with that law is probably pretty low anyways. So I'm not sure there's much difference there. All right. So what they're suggesting on his is he will have primary deficits of about 5.8 trillion over the next 10 years. Okay. Now, incorporating some of the positive economic feedback, because some of his spending is more focused on economic growth, it's going to offset a little bit. And so his net deficit is 4.1 trillion over the next 10 years. Okay, so just comparatively, Kamala Harris 1.2 trillion or 2 trillion really over the next 10 years. He's at 4.1 trillion over the same 10 years. So you can see what's the difference. Well, Trump is not, he's lowering taxes. So he's lowering the income from the for the federal government, and he's not cutting spending.
Mm-hmm.
So whenever you do that, you wind up with more debt, okay, more deficits. The Wharton School also says this does not include any of the costs that may be occurred from not being able to finance these debts or deficits, right? So it's something to always keep in mind that we're whenever you issue debt, you're beholden to the person buying that debt
Right.
and what yield, what investment return they want. So
So that's not including interest on that debt?
correct. That is
Oh, wow.
just presuming that these are passed and that's what it is. Now, they do include positive and negative GDP impacts. So that's incorporated in here. So, presumably, what they say is Trump's campaign will be very good for certain industries, a little more capital investment, and those types of things should pay off in the future. But it's beyond what the 10-year horizon usually is. So again, do you have to increase taxes beyond that point to fund it, or what? Because it's presuming you can borrow this amount of money, no problem. So one of the things that he's talked about is repealing the SALT cap, which is SALT cap is
State and
state
local.
and local taxes. Yes,
Yeah.
thank you. State and local tax cap, which he put into place in 2016 with his Tax Cut and Jobs Act. So if he's actually coming back and saying, okay, I'll repeal that cap that I put in. And so that is part of the issue of, again, reducing taxes and not not having offsets to spending on that front. So again, there's a lot of things that need to be had. It really depends on your income level, who does better. Under Trump, high income earners do far better than they do under Harris. Okay. If you're a lower to middle class, you do okay under Trump. I'm not going to say you don't do bad. You do okay, but you do better under the Harris economic policies, at least as they're announced and as they analyzed them today. Again, we're not making any value judgments on this, whether it's right or wrong. We're just saying this is what the Wharton School has determined to be the economic impact of those policies over the next 10 years. So,
And when we're talking about high income earners, again, I want to be super clear
yep,
there too. Like right now, the 2024 brackets for taxes filed in 2025 for married filing jointly, the 37% is the highest bracket right now, and that is for people, highest marginal bracket, make sure I'm really clear about that, is for people making $731,201 or more. So over $731,000 of income, of reportable income, right? That's your income that is on your tax return. That's not, a business that has a gross revenue of 700,000 or $1 million, right? We're looking at the net numbers when we're looking at federal income tax rates. So it's really like when we're talking about the high income earners, we are talking about a small percentage of the population.
yes,
Um, since most people are not in the 35 or 37, the 35 or 37% marginal rates um, right now as a percentage of Americans.
yeah. Another thing I want to talk a little bit about is uh, I'm unsure how much of the immigration issue is incorporated into those economic projections, because um, Trump has announced that he wants to deport 1 million people who are undocumented workers and deport them. Um, and the budget model talks about costing about $50 billion a year in extra expense to deport them.
Wow.
Uh, and over 2 decades, the cumulative will cost about $350 billion in economic growth. So our economic growth will be lower by 350 billion because we've we've shipped over 1 million people out of the country. Um, it depends on the skill distribution of those people and how, what they're doing for jobs. Most likely they're not doing very skilled labor. But if you have a bunch of carpenters and plumbers and the like, that starts to add up even more. So again, I think it's interesting that we have to think about that as well. There's only 3 ways to generate economic growth. And I'm going to repeat these because I think it's really important that the American populace understands that you either have natural resources, okay, which we have a tremendous amount of natural resources in the United States, or you have labor, okay, labor, or you have technology that converts things, okay? And that's where the United States shines, right? We have some of the best technology in the world. We've become some of the most productive workers in the world via that technology. But if you get rid of a bunch of workers in areas that you can't readily use technology to replace them, then that becomes a problem.
Mm.
Right? It becomes a problem because now you just have less labor, which means fewer households, which means fewer consumer spending. 2/3 of the US economy is reliant upon consumer spending. So fewer consumers, fewer consumer spending, out the door. Okay. So the gross, the aggregate income falls.
They also, a lot of even, undocumented workers, a lot of them still pay taxes too. When they work there, they are still, being from um, Arizona, I know like we have a large population of undocumented migrant workers and they still pay taxes on their wages.
Yeah. I wouldn't
And
say all of them, but I would say some of them.
right, not certainly not all, but there, I mean, it's not a small percentage either. And so to like that's always been one of the questions that I've had is just around that whole argument is like this is they're an one, they're humans, right? So that's like a big piece of it as well for me. Like these are humans. We are people that we are displacing, right? Let's talk about this a little bit more compassionately. And at the same time, they're an integral part of the economy, right? Like the jobs that are done, all of that, the wages that they do earn, spending in the economy, all of it, like they are a part of our economic fabric. Um, and so yeah, just to it's like think about that. If I just let's just cut it out. What are you're gonna leave a hole there.
Yeah, and that's where I think I don't know whether the Republicans understand or have modeled in the cost of getting rid of, I've heard numbers between 1 and 10 million undocumented workers. Uh, I know Mark Cuban asked a Republican lawmaker, have you modeled that out? Because it seems like, at a time where we are short workers, getting rid of workers, even if they're undocumented, doesn't seem like a great idea. In fact, it makes wage inflation even worse, right? Because now you have a bunch of jobs that are unfilled because you kicked them out. I don't know the dynamics between that. I wish I did, but just from a general economic theory, um, it seems like it would cause more inflation in the labor market than is currently exists. And I think that's not what they're trying to do, but I think that would be one of the unintended consequences of those actions. Similarly, tariffs are a very difficult thing. Um, Tariffs are great to punish countries. Okay, that let me step back. If you need to punish a country for unfair trade practices, tariffs are a great way to do it. Okay, because you're discouraging, you're making their products more expensive. So what happens is consumers, when they're shopping and they're shopping between two different brands, the one that's produced in the country that you're kind of not happy with, it's now more expensive. So you might opt for the other product. Okay.
I've
So that's the
also
solution.
I've also heard with tariffs that it's one of the like targeted ways that they're used appropriately is when you want to foster development of an industry or help an industry in the country that you're in. So in the
Correct.
United States, right? Like if we're using steel as an example, if we wanted to foster the American steel industry, foster more growth for them, tariffs help if we put tariffs on foreign steel so that US steel can grow, right? And put that for any industry. But it's a like a targeted action to help a certain industry, it can be effective.
Correct.
So that's another reason, like maybe not like in a punishment way, but like just in case people are like, that's not the only reason they use them. No, it's not just to punish other countries, but it would be to foster growth in a certain industry,
Yeah.
in a
But
homegrown industry.
but let's also not kid ourselves. The US consumer pays the tariff.
Right.
It's an extra tax on the US consumer. It makes the product on the shelf more expensive to the consumer. Okay. So I know um, Trump has been saying, no, it's a tax on foreign countries. No, it is not. It is not. Because
Because
who pays that is the US consumer. So
yeah,
it's a tax on the US consumer that that who pays it, and then eventually it goes back to the US Treasury. Now, it's it's an interesting point. It will definitely slow down US trade with other countries. Not to say that's not a bad thing. Okay, lower trade in certain areas is not a bad thing. Sometimes we have to foster critical industries within our country to be self-sufficient. I think during the pandemic, we all realized, hey, all of our medication is made in China and overseas. So is that a really critical product set that we want manufactured locally? If it is, great. Let's make that decision and let's move forward with those types. And I think both the Trump and Harris campaigns are on board with those types of kind of self-sufficiency, national security type um, products that they need, that they want to foster being developed and produced in the United States. So again, it'll be an interesting dynamic over the next couple months as we see further, them coming about as the election cycle, ramps up, continues to ramp up towards November 5th voting day. Um, it is going to be volatile, people. There's no way around it. The both sides are very calcified into their various positions. They're very adamant that the opposite position is completely, utterly wrong. And so whether we have a president-elect on November 5th or December 5th or January 5th, it will eventually recede into the background and the new president will then start to govern. Um, so I would just like to tell people just to take a step back. If we're going through volatile periods, just remember that you're doing this for a certain purpose. Look at your financial plan. What's your goal? Is your goal 10 years out? Is your goal 40 years out? I don't know. So Generally it's probably not in the next 3 or 4 months. So you really shouldn't worry about some of these little bumps in the road that come along. But again, just making sure that you're sticking with it, even though the narrative on social media will be very, very acrimonious.
Yes, definitely. And if you, just as a reminder, because I get this question sometimes from clients and friends and people like, if I wanted to make more money in the next couple months, where should I put my money? Like, do you need that money in 3 months? Then you do not put it in the stock market.
Correct.
Go put it in a savings account. Go put it in a high yield. Go open a high yield savings account and put it in there and get 4.5% for a little bit. Um, so yeah, gentle reminder there that we do not play, quote unquote, play in the stock market with money that is literally needed for living in the next, I would say even 6 to 12 months. Typically, we keep that safe. So this is not a time for really, do what you want. You can speculate if you want. I'm not here to tell anyone what to do. I'm just saying, like, best practices are, unless you are like a day trader and that's your hobby, then yeah, do what you want. But for anyone who has a longer term time horizon, just like you said, we don't want to worry too much about the volatility we're seeing now. We want to focus on the fundamentals that we tend to talk about pretty often. What's happening with inflation, what's happening with the business cycle, what's happening with the labor market, and forecast out from there.
Perfect.
Good. Got it. Well, as always, if anyone has any questions, if you want to hear more about anything, if you heard something and you're like, okay, you explained that, but you didn't do a very good job, can you do it again? I am always open for feedback, truly and honestly. And I know some of you hear that and you take it to heart and you give me the feedback. I take it graciously and I appreciate um anything that, any feedback that I get from listeners, from clients. So if there's something that we talked about that you want to hear more about, if you want to know more about options, if you want to know less about anything, tell us. Like, I want to hear about it. So you can get me at Hannah, Hannah, at expansiveceo.com for the podcast. And Brad, how can people get a hold of you?
You can get a hold of me at bhaines, BHAINES at juncturewealth.com, or you can call our offices at 480-253-4100.
All right. Thanks for being here, Brad. We'll see you next time.
Thank you.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, Hannah, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough. You are enough. And your birthright in this lifetime is to be expansive.